All over social media, you can see people being bullish one day, bearish the next day, YOLO investing, getting paper hands, whereas institutions, they cut through all the noise and they make serious investment decisions. All right, what's up, folks? Welcome to CryptoFAQs, and today we'll be analyzing the interview between Michael Saylor and Ben Cowen on his YouTube channel, Into the Cryptoverse. Now, Saylor has a lot of interviews, both long and short, all over YouTube as he tries to evangelize Bitcoin. But in this particular interview, we were lucky to hear Saylor's thoughts on several new topics, all of which we'll be diving into. As usual, we'll start with the high-level takeaways. So Saylor opened up the conversation with this idea of dematerialization, what he believes to be the largest value prop of Bitcoin. They also discussed portfolio diversification and if that's even necessary. They talked about how institutions began putting Bitcoin on their balance sheets. They debated whether fundamentals trump any technical analysis given the paradigm shift that Bitcoin introduces to the world of money. And they closed out the conversation discussing financing or using debt to procure Bitcoin, which is a little different than leverage. And of course, we'll close out this video with my conclusions on everything we just heard. So the first topic, how Bitcoin's biggest value prop is what Michael calls dematerialization. What he means is that most of the world's value comes from engineering newfound scalability and flexibility into the things we find useful. Libraries eventually became ebooks, and it was a lot easier to spread knowledge around the world. Music, which used to be a very physical endeavor, can now be streamed in the highest fidelity we've ever seen. And in this case, gold as a store of value is now becoming digital money. So we're taking a very valuable idea and unlocking its potential to make a widespread impact. And that's what really generates the value that we see in Bitcoin. Bitcoin specifically digitizes a number of things and unlocks a lot of value. You can track property rights through the blockchain and in effect also manage your wealth. You no longer need to have physical gold, and we're effectively digitizing the monetary system, which for thousands of years has been something that we've expected to be physical and not necessarily scalable around the world the way that Bitcoin allows it to be. So the value prop of Bitcoin is that it's a flexible store of value combined with financial sovereignty. Now, gold is reliable as a store of value too, but it comes with its own headaches. Mainly that if you have enough of it to represent meaningful wealth, it's too bulky to do anything with anyway. But gold also has very little sovereignty because when push comes to shove, governments can simply escalate and confiscate your gold wealth. Michael used the example of countries in South America that forcibly converted all of their dollar currencies into domestic currencies to prevent folks from leaving the devaluing currency, preventing movement of the money out of the country. But Bitcoin can't be confiscated because there's no one in the middle, and it can't be devalued because the protocol can't be arbitrarily manipulated like fiat. So a cogent way to summarize what Michael's getting at with a Saylorism that I wrote is that we're digitizing the fabric of society. If we digitize money, property rights, the financial system, and essentially how society works, we're unlocking an unparalleled value prop when it comes to flexibility and scalability in how society operates. My thoughts on this section were pretty positive. I think Saylor had some very powerful ideas, although they were expressed in a somewhat convoluted and long-winded way. And I think the institutional perspective, although it's a little different than the retail perspective, it's very useful to understand how big players with a lot of skin in the game are thinking about a transformational financial technology. The next topic was whether the value prop of Bitcoin makes portfolio diversification irrelevant, because if it's such a monumental thing, does it even matter to invest in anything else? And tech equities seem to be the only real high return option out there. But Saylor effectively says that yes, diversification is not really necessary for two reasons. Mainly because everything is valued in fiat and that depreciates to zero, so it doesn't really matter. And history shows us that even if it doesn't depreciate to zero, the regime, your empire, your government will eventually seize it anyway. So why not invest in something that escapes both of these points? Saylor also mentioned several benefits of Bitcoin relative to other assets that further his point against diversification. One of those is that Bitcoin isn't currently classified as a currency, at least in the United States and mostly everywhere else. So this creates a win-win situation for both the holder of Bitcoin as well as governments. For the holders of Bitcoin, they have an incentive to keep it as a store of value because it functions more like gold, precisely because it's not treated as a currency, it's more like property. So you can put your wealth into it the same way that you would put wealth into a house. On the flip side, because it's property, it's taxable every time you trade it. So it's very similar to equities and the fact that you pay capital gains every time you want to give it to someone or sell it or something like that. This taxability is very beneficial for governments. DeFi is another aspect of cryptocurrency that Saylor feels strongly about, and we heard that when he started discussing with Ben whether or not we should diversify into Ethereum. So his takeaways here are that DeFi primarily functions to evade KYC. The fact that there's no middleman and you can trade directly with people in the marketplace without any sort of central entity is not something that governments are going to like in the long term. More than likely, they're going to try to prevent this from happening because having a central entity control things is a little bit different than KYC and not even identifying who's transferring money to who. According to Saylor, this is what's going to limit the growth of DeFi, which is not really the central value prop of Bitcoin. Therefore, it's not a limiting factor there. And finally, land. This is kind of an analog that Saylor uses when referring to what it's like to own Bitcoin. He mentions that owning Bitcoin is like owning land when America first started in central Manhattan. All you really could have done is bought a sizable chunk of land in Manhattan, held it for 200-300 years, and you would have had the biggest gains, you could think of. And so owning this foundational piece of the investment puzzle is what allows you to get first order gains. So building a building on top of that land in Manhattan is second order gains. Starting a business inside of the building that was built on top of this land in Manhattan, that's third order gains. You can do all of those things, but you can keep it simple by simply owning the foundational asset, which in this case is land or Bitcoin. Why build all kinds of things on top of Lightning Network or with Ethereum or anything like that? While those serve a purpose, if you're looking to invest, which is what primarily institutions are trying to do, you can treat Bitcoin similar as a land investment 200 to 300 years in the past. On this section, I have a lot of thoughts, and some of them are positive, some are not so positive. I think regulations can reduce the value prop of anything in crypto at a moment's notice anywhere in the world. They can be financial in nature or political in nature, so it's really difficult to call Bitcoin the de facto investment instrument over the long term without really seeing how things are going to play out in the regulatory environment. I also don't think DeFi is going anywhere, even if KYC becomes a major regulatory hassle. Because even if you can't go on Uniswap and anonymously trade cryptocurrencies with people, DeFi still unlocks tons of value to revolutionize finance by removing the financial middleman. So as soon as people figure out scalable and meaningful applications of DeFi, we're going to see tons of value unlocked here, regardless of KYC. Next, when Ben pressed Saylor further on diversification, he finally said you can maybe buy things that people will always find valuable. Trophies, sports teams, and things I like to call rich people assets. I think this is a very ivory tower mindset because most folks don't have trophies and sports teams to diversify with, nor would they really want to. The people that benefit the most from cryptocurrencies, those folks with little access to banking or in countries with rapidly debasing currencies, they want to have liquidity and they want to make sure their wealth doesn't evaporate in real time. This point is completely irrelevant, and I think a lot of the examples Saylor used throughout this part of the interview are extremely hyperbolic. Even if everything in the world depreciates to zero in terms of fiat, we still have all of these companies all over the world producing value, physical value. You can still invest in companies like Amazon and Google and other companies and other industries and still preserve your wealth. The yardstick you use to measure that value is irrelevant. The next section was a lot more lighthearted. What is Bitcoin like for an institutional client? We haven't heard Saylor talk much on this topic before, maybe because it's just administrative for institutions and big players like him. But I think for regular folks, this is extremely interesting to see how the big businesses are coming in. The institutional onboarding process, according to Saylor, is fairly straightforward. It takes around 18 weeks for a public company to deliberate with all shareholders and then buy in through an OTC. And it takes slightly less, around 12 weeks, if you're a private company, primarily because there's not a lot of outside shareholders that you need to get on the same page. It's just all the folks that own the company that's private. But why does it take so long? Why can't a company just have a few conversations and buy through OTC the same way that you execute a purchase on the spot market? Well, it takes time for institutions that aren't allowed to buy Bitcoin directly. For example, hedge funds, they need to post quarterly profit numbers, and sometimes the volatility of Bitcoin can inhibit something like that. Pension funds also, they're not allowed to buy Bitcoin directly, and so they need exposure through different sort of instruments, indirect exposure essentially. There's a lot of restrictions on what instruments big institutions can use to get exposure to Bitcoin if they decide to go that way. And they get that exposure through indirect instruments like ETFs and bonds, like what MicroStrategy is issuing. But you're not physically buying literal Bitcoin. And more to the point, there's a lot of risk management. You can put in $1,000 into Bitcoin, and because it's just 1,000 of your dollars that's not related to anybody else, it can go down to $1 and then it can go to $10,000 the next day, and then it can go back to $1,000. If you can stomach that volatility, you'll be fine. But businesses are not in the business of buying Bitcoin. And if they're getting exposure to this to buffer their balance sheet or whatever, they need to make sure that they can predict what's going to happen to it in the future so that all the shareholders that signed on board don't get freaked out because now they're getting exposure to volatility that is way beyond their expectations. The next big topic was whether or not you even need technical analysis to make an investment decision around Bitcoin. And this was a really interesting philosophical debate because Ben built his entire YouTube channel on tough mathematics and solid technical analysis, whereas Saylor says all of that stuff is irrelevant and you can just stick to the fundamentals of Bitcoin to make a good decision for a number of reasons. The biggest of which is that Bitcoin is a paradigm shift in the way we think about money and finance and wealth. So the possibilities that Bitcoin unlocks, they work so differently than the financial systems and everything that we're used to that a technical analysis only introduces noise in long term. Looking at historical price action relative to fiat currency, which is only depreciating, so that's looking at BTC relative to USD, for example, it's not very useful. To make this more clear, we can look at other things in history that were also big paradigm shifts. For example, would you measure the performance of the iPhone, the love for the iPhone, and everything that the iPhone has become today based on flip phones? Not really. I mean, you can maybe make some assumptions that the iPhone is better and things like that, but the iPhone is such a different thing and it's introduced such a different way of life that extrapolating data from flip phones, which in this case is USD currency or fiat currency, it just doesn't make sense because they're so different. You can't predict one from the other. Some more examples. Would you compare steel versus clay bricks? Think about the kind of buildings you can build with steel versus clay bricks. Guns versus bow and arrows, and how they change the way we've hunted and built modern society. So the same thing can be said for Bitcoin versus fiat currency. It's a completely different thing. Now, to be clear, don't misinterpret Saylor's distaste for technical analysis in meaning that it's completely irrelevant. So in the short term, you can make a prediction of where the price is going to be in a week or a month or something like that to get in perhaps at the right price. But because you're unlocking a new dimension or a new way of thinking, technical analysis is not really going to get you very far if you want to make a very long-term, robust financial decision. To summarize what Saylor's trying to say, the environment has changed and fiat currency all over the world is collapsing. So really the price of Bitcoin is irrelevant. You just want to have all your wealth concentrated in Bitcoin because Bitcoin is introducing a fundamentally different way of operating. So technical analysis is not going to really help you make a meaningful yes or no decision. So I think Michael and Ben are sort of mismatching points. Ben does not use his YouTube channel to make price predictions 5-10 years out into the future. You can only really do that with fundamental analysis, and in fact, that's what people do in all industries in any business. They don't use technical analysis for a price 5 years from now. They use fundamental analysis to make assumptions. So I think macroeconomic charts may be more up Saylor's alley. And we're gonna have a video on CryptoFAQs looking at big idea charts. So not really fundamentals of Bitcoin, because you can watch a lot of videos on that, and not technical analysis with price action, but things that show you whether or not Bitcoin is going to accrete or dilute in terms of value over a very long period of time. I think this was a really good section. I think it was mostly accurate. I think Saylor was just a little bit hyperbolic. And I also think that, again, Saylor and Ben are mismatching their perspectives a little bit. MicroStrategy is placing a big bet on Bitcoin becoming the de facto financial measuring stick in our lifetime. I like the fact that they're putting their money where their mouth is. Owning $2 billion worth of Bitcoin when you're hyping it up like this is awesome. But still, I think it's too early to tell that Bitcoin is going to be the definitive thing to put your money into. And I still believe that we're going to have to diversify. And if you want to figure out when to get in and when to diversify, technical analysis is still the way to go. But if you have a ton of money, like Michael Saylor's company does, yeah, then it doesn't really matter because you have so much capital, you can dollar cost average so much over time. It's peanuts whether you get at 27K or 37K or whatever price. As long as you're not making completely horrible decisions, you'll be perfectly fine. The last section they wrapped up with is, what about financing Bitcoin? How about taking out money against your assets or using debt to purchase Bitcoin instead of straight cash? So financing Bitcoin is different than leverage because you're borrowing money against your assets. You put up something as collateral. So the biggest difference is that long-term debt isn't usually marked to market. What happens is you take out a loan based on an asset that you have, and whatever happens in between today and the end of the term is kind of up to you. It's just your obligation to return the money and maybe some interest at the end of the term. That makes big price swings, such as the ones that happen with crypto, totally okay because no one's really looking at what's happening in real time. Versus with leverage, if the price falls too far, you become over levered, the company that gave you the money is going to get freaked out and start to margin call you, asking you to put up more money to offset the decline in the price. This is a good way to go if you have the means and if you don't see any issues with Bitcoin fundamentals in the near term. So you could still get unlucky in that the price of Bitcoin falls or is in kind of a bear market for an extended period of time that happens to coincide with the end of your loan term. But this is certainly way better than kind of the flash loans you get with leverage. This is a great point. And this is how wealthy folks spend their wealth without having to sell it first and pay taxes. Their stock price appreciates, and you can see in public disclosure forms from the SEC how much of their companies they own. So as the price appreciates, they don't actually realize those gains by selling, and instead they take out loans and continue to grow their wealth that way. In other words, it's cheaper to just take out a loan against those assets and pay back the loan with interest. You can do this if you're not that wealthy. You don't have to be Jeff Bezos, but you do have to have a lot of creditworthiness and reasonably valuable assets. If you've heard of S-blocks or HELOCs, which stands for security-based line of credit or home equity line of credit, regular folks can take out lines of credit against equity in their portfolio, or if they own their home, and use that money to finance, in this example, a purchase of Bitcoin. But certainly, Saylor is finally recommending something that an average Joe, if you will, can do. So, some conclusions. I think the institutional perspective is invaluable for building diamond hands. All over social media, you can see people being bullish one day, bearish the next day, YOLO investing, getting paper hands, whereas institutions, they cut through all the noise and they make serious investment decisions. In theory, if you just follow the institutional perspective over the long term, you'll make out a lot more than if you listen to all the hype you see all over social media. Saylor also brought up some interesting points on diversification and debt financing. Diversification is still something you should strongly consider, and debt financing is a great option if that's something up your alley. Also, despite avoiding the questions on diversification, I'm pretty sure Saylor is still diversified. He does own Bitcoin personally, and he does obviously have a stake in MicroStrategy being their CEO, so that in and of itself is already diversification. I have a hunch that he does also have a bunch of other equities and things that he's invested in. He just doesn't want to disclose that in a public forum because there is some conflicts of interest there and can influence the markets too. Debt financing can't be said enough. It is a gigantic benefit, especially now, because inflation is high and interest rates are low. Money is getting really cheap. So if there's any time to take out a line of credit to buy something like Bitcoin, it could be now. To be clear, this is not financial advice. You got to figure out your own thing. So overall, I would be very careful of hyperbolic Bitcoin maxis. There's so much noise out there of folks who are just super gung-ho on Bitcoin, people who are bearish and bullish because they have some affiliate kickback that they're looking for, or they have some vested interest in Bitcoin being high or low for political or financial reasons. You really need to do your own research and poke holes in everything that you read. There's a lot of important folks out there who have a lot riding on the success of Bitcoin. There's a lot of folks out there who are trying to profit from the downfall of Bitcoin too. Really use critical reasoning when making investment decisions in such a volatile and new growth field. And with that, thanks so much for watching. Be sure to like this video and comment down below. Start that discussion. What did you like? What do you disagree with? What did you learn? Be sure to subscribe to CryptoFAQs and hit that notification bell so that you can stay up to date with our latest videos. And of course, follow us on Twitter at the CryptoFAQs because someone else has already taken CryptoFAQs without the. Maybe if we hit 1,000 subscribers, we can afford to buy them out. Remember, feedback is your gift to me. Everything you tell me goes into these videos. I know what you like, and everything I learn helps me make better videos for you. So thanks for watching, and I will see you guys next time.